Welcome everyone and thank you for watching. A solid start of 2025 for Galp, continuing to showcase operational resilience now under volatile market conditions. Group EBITDA reached 669 million euros in the quarter, with strong performances across our Iberian businesses offsetting a slightly lower upstream contribution as planned. Production stood at 104,000 barrels, reflecting turnarounds on 4 units and a number of stoppage days already at over 40% of our full-year plan. Faced with current volatile commodity price conditions, our portfolio's cost efficiency has been particularly reassuring, with production costs remaining below $3 per barrel and a cash break-even holding at around the $20 Brent mark. Also, on a positive note, in the final days of the quarter, we successfully completed the divestment of our stake in Mozambique Area 4, crystallizing value and further strengthening our financial position. As for Namibia, another successful well was concluded in February, safely drilled, and unlocking a new exciting area within Mopane, now in the southeast part of the complex. We also finished proprietary seismic works, which should be now about a year to be fully integrated. In the coming months, we will continue to assess and integrate data in our models and advance on feasibility studies. In parallel, we're starting to re-engage with potential partners, mindful that the process towards a value-accretive partnership will likely take time. Industrial and midstream contribution was strong, delivered through another set of solid performances across oil, gas, and power trading, as well as through soundalization of the refining system, even though bad weather conditions momentarily impacted full availability. In April, we finally lifted our first LNG cargo from Venture Global, which was originally expected in 2022. The sales and purchase agreement foresees the supply of 1 million tons per annum of LNG. This was not included in our original numbers for 2025, so it is a potential upside to our guidance. As anticipated, commercial reflected its normal seasonality, delivering steady EBITDA year on year. We continued to reap the supporting contribution of our growing convenience and energy solutions businesses, generating 44% of commercial's EBITDA. In renewables, we optimized our revenue streams, sustaining our realized prices through ancillary services. This quarter also marked the commissioning of our first battery pilot in Iberia, a small 5-megawatt project that should be seen as the first stepping stone for further optimization of our solar PV portfolio. The combined solid performances across all our businesses supported our operating cash generation in a period in which we typically have a phasing effect given the higher concentration of paid income taxes in Brazil. We had a relevant working capital build, driven by a more normalized receivables balance in upstream after last quarter's significant release, and by an isolated crude oil inventory build in refining, given momentary logistic restrictions caused by weather conditions. As we process these cargoes, part of this working capital build should be naturally diluted throughout the following quarters. We maintained a strong execution pace across all our transformative and growth projects, with CapEx amounting to 295 million euros, including the latest exploration well in Namibia. This quarter, we also received the final earnout from the Angola divestment and, as mentioned, completed the Mozambique deal with a relevant inflow in our cash flow statement. Bottom line, we ended the quarter with a free cash flow of 186 million euros and a favorable position to deleverage in the coming quarters. All in all, a good setting to sustain our momentum going forward and to deliver on our guidance for the full year despite the macro uncertainty. Thank you again for having joined us.